Welcome to the course Depreciation, Alternate Investment and Profitability Analysis. We are continuing with the module 3, that is profitability analysis. In this lecture, I will discuss a method for profitability analysis that is called discounted cash flow part 1. Now, these discounted plot cash flows are the type of methods which use time value of money. Earlier methods which we have discussed for profitability analysis, they do not use the time value of money, but discounted cash flows use the time value of money. So, that is why these are the different methods than the earlier ones. In capital budgeting, discounted cash flow analysis is a method for valuing a project, company or asset using the concept of time value of money while estimating the cost and benefit of a given project. Though there are many variations in this method, but all methods require cash flow to be discounted at a certain rate, that is the cost of the capital, which is the minimum discounted rate earned on a project that leaves the market value unchanged. These methods take into account all investment costs and benefits that the project incurs during its entire life period. The important characteristics of DCF, which is discounted cash flow capital budgeting, is that it takes into consideration the time value of money while estimating the cost and benefit of a given project. Theoretically, the DCF is arguably the most sound method of valuation. Discounted cash flow models are powerful, but they do have shortcomings. Commercial banks have widely used discounted cash flow as a method for valuing commercial real estate construction projects. This practice has two substantial shortcomings. Number 1, the discounted rate assumption relies on the market for competing investments at the time of the analysis, which would likely change perhaps dramatically over time. And number 2, the straight line assumptions about income to increase are generally based upon historic increases in market rent, but never factors in the cyclic nature of many real estate markets. Most loans are made during boom real estate markets, and these markets usually last fewer than 10 years. Now, thus the discounted cash flow valuation should only be used as a method of intrinsic valuation for companies with stable, predictable cash flows. Discounted cash flows, that is in short it is called DCF analysis, includes methods like net present value method, internal rate of return method, net terminal value method and profitability index. The net present value method. The net present value method is a discounted cash flow method in which present value, that is PV, of the DCF is used. NPV is described as the summation of the present value of cash flow after tax, which is called CFAT, in each year minus the summation of the present value of net cash outflow in each year. Now, the formula for this is NPV can be mathematically expressed as NPV is equal to summation I equal to j equal to 1 to n CF8TJ divided by 1 plus I to the power j plus SB plus WCA divided by 1 plus I to the power n minus summation j is equal to 0 to n COF j 1 plus I to the power j. Now, where CF80J is the cash flow after tax at jth year, I rate of return generally based on cost of capital, n equal to lifespan of cash flow of project, SB salvage value of the project at the end of the lifespan, WCA is the working capital, COFJ is the cash outflow at jth year. The accept reject rule for a project evaluated by NPV is to accept the project if NPV is positive and reject if it is negative. Now, through examples let us explain this. So, for this purpose we take the example number 1. The objective of this example is give the value of cash in given the value of cash inflow to project and cash outflow from project, compute net present value, that is NPV. Example is the cash inflow after tax of a given project is shown below. The project costs 60,000 at the start and then 20,000 at the end of third year. Cost of capital is equal to 20%, this is basically I. Find the value of net present value. So, if I see the timeline, at t equal to 0, 60,000 is invested, and t equal to 3, the end of the third year, end of the first year, end of the second year, end of the third year, another 20,000 is invested in the project. And whatever the receipts are given here. Year 1, 2, 3, 4, 5, 6, cash flow after tax, this is 12,000, this is 13,500, this is 14,800, this is 16,543, this is 18,760, this is 19,567, and the summation of this is 95,170. And obviously, it is a net present value. So, at t equal to 0, 60,000 is invested, and after 3 years, end of the 3 years, this 20,000 is invested. So, this has to be brought to this timeline. Similarly, here all these values have to be brought to the timeline t equal to 0. So, if I see here this t equal to 0, this is 1, 2, 3, 4, 5, 6. So, this is receipt is 19567, this is 18,760 like this, and the first year this is 12,000. So, all this has to be brought to the 0 timeline. And then we add these values up, and then take a difference and see whether the NPV net present value is positive or negative. So, let us solve this problem. Now, solution. Example 1. Initial cost of the project is 60,000. Now, the cash outflow of 20,000 takes place at the end of third year. This 20,000 takes place at the end of third year. So, present value of this cash flow, value of rupees 20,000 cash flow at the end of third year is equal to 20,000 divided by 1 plus 0.13, this comes out to be 15,026.30. So, I add here 15,026.30, this comes out to be 7,526.30. So, this is my investment in the present value term. So, this value here is rupees 75,026.30. Now, all these values has to be converted into time t equal to 0, that means the present value has to be computed and then added up. So, if I do that, so the PV factor for this present value factor for this is 1 divided by 1 plus 0.1 to the power 1, this comes out to be 0.909, this is 1 divided by 1 plus 1.1, 2, this is 1 plus 0.1, 3, similarly this 1.014, this is 1.015, this is 1.01 to the power 6. So, if I calculate these factors are 0.826, this is 0.751, this is 0.683, this is 0.621, and this is 0.564. And if I multiply this with this, so my present value of this value is 12 1000 multiplied by 0.909, this comes out to be 10908. Similarly, if I do this, this comes 11156, this comes 11119, this comes 11298.87, this comes 11648.1, this comes 11045.1, and if I add them together, the sum is 67175.1. Now, so NPV is equal to, so summation of all these things becomes rupees 67175.1. So NPV is equal to 67175.1 minus this value 75026.30, this comes negative 7851.2. So this is a negative quantity. That means whatever I am investing, I am not getting back due to the profit. So my conclusion is, as the value of the NPV is negative and hence the project is not acceptable. But a further analysis shows, because if you see the difference is 75026.30 and 67175.10.21. Now let me quickly do it without error. This is 75026.30 minus 67175.10. This is coming 7851.20. This is the deficiency. Now if we see the investment, what we have done here, the cost of the investment comes out to be, this investment costing me here is 15,026.30. That is, this is the value here if I transport this to present value. That means if I am not investing this money into the project, then my NPV will be positive, because the difference is only 7,851.20, and if I drop this expenditure, which is 15,026.30, my NPV will be positive. So I should look that whether doing away this expenditure can solve my problem or not. Now let us take another example. Example number 2. Now the objective of the example number 2 is compare the present value or discounted cash flow of given cash flow when interest rate is given. Also compare payback period for undiscounted as well as discounted cash flows. Now the example number 2 is find out the discounted cash flow present value of two different machines A and B from the data given. Now cost of capital cost of capital is 10%, that means I is 10% or 0.1 in fraction. Initial cost of equipment A is equal to 10,000. Now, initial cost of equipment B is equal to 13,000, and cash flows after tax machine A, machine B, this is 1, 2, 3, 4, 5. This is 2460, 3256, 3326, 2156, 5210. This is 1980, 2678, 8769, 7650, 4320. So, obviously, this cash flows are at different timelines and has to brought to the timeline 0. Now, for the machine A, if we take, this is timeline, at t equal to 0, I am sinking a money of 10,000, this is A, and I am receiving money 1, 2, 3, 4, 5. Now, this value is 2460, 3256, 3256, 3326, 2152, 2156, I think, 2156, 5210, 5210. So, all these monies have to be, its PV has to be calculated. And then we have to add it up, and whatever value comes out, we will deduct 10,000 and see that NPV is positive or negative. So, for this, if I see the PV factor, which is basically 1 by 1 plus I to the power j. So, the PV factors are 0.909, 0.826, 0.751, 0.683, 0.621. Now, how this is calculated? Let us pick up this. This is nothing but this investment 3256. So, here this is for 2 years, it has to be brought back. That means, this factor is 1 plus I is 0.1 to the power 2, and this comes out to be 1.1 to the power 2, and that inverse of it comes to be 0.8264. Similarly, let us calculate for this. This is 1 plus 0.1 to the power 5 comes out to be 1.1 to the power 5 equal to this, and the inverse of this is 0.621. So, I have shown you how this PB factor has been calculated. Now, if you multiply this, then we get a present value this is machine A, this is machine B. So, I get present value 2236.14, this is 2689.456, 2497.826, 1472.548, and this is 3235.41, and if I do the summation, this is 12131.38. Similarly, if I calculate this is 1799.82, 2212.02, this is 6585.519, this is 5224.95, this is 2682.72, and if I take the sum, this is 18,505.037. Now, this is more and this is less. So, the cash outflow for both the machines are negative, and hence we cannot select this machine because the NPV is negative, we cannot select these machines. But if we find out the payback period for this, if we find out the payback period of this, PB of machine A is equal to 10,000 divided by, because if we add them up here, this is 16,408 and this is 25,397. So, this is 10,000 divided by 16,408 comes to be 0.61 years, and PB of B comes out to be 13,000 divided by 25397 is equal to 0.51 years. And if I use these discounted values, present values, then using PB values, then this PB of A is equal to 10,000 divided by this value, which is 12131.38, is comes to be 0.824, and PB of B is 13,000 divided by this value 18,505.837 comes out to be 0.703. Now, we see that these values have considerably increased when I am using the present value of the cash flow. Now, let us summarize. And with this lecture, I have started a new method which are called net present value method, which comes under discounted cash flow methods, because discounted cash flow methods are time adjusted methods, and we have solved a few problems. We have also solved a problem using the net present value method and payback method, and we saw that if net present value of the cash flows are used, then the PB of the machines increase. Thank you.